discount to the carrying value, I need to less the premium on the carrying value. Rather going into that one, if your company policy is that you need to use straight line method dealing with the discount and premium, then remember it will smooth out the discount and premium. So if you see here, the premium is not smooth here, right? It's different. In fact, it is increasing. 1 year it is 336, other year 349, other year 363, 378. So it's not the same value. Similarly with the discount, it's not the same value. So if you want everything is smooth out, easy, pretty easy, so you use straight line method. Remember, this is normally used by small companies, but big companies, remember, if you smooth out, it's like millions of dollars, right? $336 million and 363. There's a huge gap between that one. If you want to smooth out, maybe you are disturbing your whole profitability analysis of your whole income statement, right? So we will be dealing with this illustration right after a small break. So let's meet after 5 minutes break. So up till now, everyone understand that? The premium bond issued at premium?
Yes.
Pinyo, Nam, Marilyn?
Yes.
Okay, so let's meet after 5 minutes. Hey class, welcome back after the break. So we were talking about the straight line method for amortization of the discount or premium. So let's understand it through an illustration here. So suppose Southwest Financial Vice President is considering issuing 9% bond at 96,149. So remember how, so they are considering to issuing 96,149. What does it mean? It means they are all already issuing it on discount. So remember the discount would be 100,000 minus 96,149. Answer would be this 3,851. So if you are using it as straight line, so divide the number with the periods. So if they are, so we already know that in our previous example of discount, this bond issued for 5 years. 5 years means 10 payments of interest. So this discount gonna be spread on 10 payments. So it means on average, every payment we will be retiring, or we will be decreasing discount 385, right? So 9% bond semi-annually, which means 4.5%. One period of interest is 4.5% for 6 months. So cash payment is going to be 4,500, no change in that. And interest expense is going to be, because interest expense now is not based on market interest rate. Why? Because we want to calculate the market interest rate based on to adjust this discount, But we divide this discount into equal payments. So how much is the interest expense? Just add this into our payment. So interest expense going to be 4,885. So this would be your fixed amount of interest expense, and this would be your fixed amount of interest payment. So in that case, your interest expense and your interest payment will not be disturbed. So if you look at here in our amortization table of premium here, so you see the interest expense is changing. This is a case of premium. If this is a case of discount or premium, if we are applying it through straight line method, this would be the same, like here 4500, 4500, 4500. Here it would be 48 something, 48 something, right? So we 4885. So over this entry would be our fixed. So with no change in interest expense on every period, no change, of course, no change in our bond, discounted bond payable, the entry would be the same, amount would be, even amount would be the same as well, right? So through straight line method, it is just a method to divide equally the amount of discount and the amount of premium. In case of premium, it would be less from the payment. In case of discount, it would be add in the payment, because in discount, interest expense greater than interest payment. In premium, interest expense is less than interest payment. So this is a small concept. You need to remind that. So now there are some questions. Should we retire our bond before maturity? We issued our bond for 5 years. Can we pay back the whole amount after 3 years? Answer: can be and cannot be, because you promised to pay the coupon rate for 5 years. So as a bond holder, if I am getting higher interest rate, I won't allow you to pay me my whole money and end my interest payment for next 2 years. I don't want to do that, right? So for that reason, if you are retiring it, you must add into your bonds contract, or you can add callable feature that we can call our bond. The company can call its bond back after some period of time. So its pre-arranged price going to be mentioned as well, right? So that both parties could agree, right? So reasons to early retire or early, payment of the bond is that maybe in the market interest rate go down and it's not improving. You are paying 9%, and in the market is now interest rate is 2%. So you are paying 9%. It's too much interest cost. If you take loan from the bank, you will pay 2%. But if you already issued the bond and you are paying 9%, so you add a callable feature to the contract and you say that we can, after 2 years, can pay back or call the bonds and will give you your money and interest back at pre-arranged price, so that you are not adversely hit by interest rate risk or interest rate change, right? Okay, any question regarding bonds payable, premium, and all the stuff? Ella, you?
No questions.
Marilyn? Okay.
No questions, sir.
Now, moving to our last topic, which is stockholder equity or owner's equity. So first, our learning objective number 1 is the feature of corporation. We are not going to waste so much time here because we already know that. We already talked about the feature of corporation. So why we are not going into partnership or sole proprietorship? Because in partnership and sole proprietorship, we cannot raise more capital. If we want to raise $1 billion, $2 billion, $10 billion, so no one going to give us the money unless we issue shares to the public and public contribute to our company. So the one advantage is that we can raise huge capitals. The second point is the owner can die, but company name cannot die. In partnership, if one partner dies, its name must be changed. But in case of corporation, because corporation in the eyes of law, it's an entity, it's like a person, it can own a property, it can own, it can open an account on its own name. It can be sued against, any in the court of law. So its name doesn't change. Owners can be changed. You can sell your shares to somebody else. He become the owner, but company name doesn't change. So you can easily transfer your ownership in case of partnership and proprietorship. If you transfer your ownership, company name changes. The most important stuff is limited liability. You are only liable to the amount of your investment. Your personal property will not be involved in case if the corporation make a loss. The biggest disadvantage is that those who own the company and those who run the company, they are different persons. So management is under the shareholder. The management should work to increase the wealth of owners, shareholders. But managers, normally they work to increase their own salaries. We call this agency conflict, right? So that is the management discussion or introduction to business discussion. So we are not going into that one. The biggest disadvantage, other disadvantage is that it is taxed twice, double taxation. So when company earns, company is taxed. When company distribute to the owners, owners' income are taxed. So double taxation is there in case of corporation. Plus, it's not easy to set up company. There are tons of regulations you need to follow. Every year you need to present your income statement, your balance sheet, your statement of earning, your cash flow statement to the Security and Exchange Commission where you register your company, right? So organizing a corporation, it is organized through a charter, through a legislative process that you cannot go beyond the charter of the organization. If you are a Samsung company and you are making laptops, you cannot enter into home appliances unless you change your charter. So you need to work on your charter, right? You cannot, if you are a Samsung company, you cannot go into rocket space. You cannot go into oil drilling company because your charter doesn't permit you, right? Similarly, you need to obtain authorization of the shares. That how much is the maximum shares you can issue? Authorized. For example, 1 billion shares. Company in its lifetime can only issue 1 billion shares, not more than that. Maybe the paid up capital company only issue 10 million. Rest of 9 million it will be issued later. So that is the paid up capital or outstanding capital. That is authorized capital. Authorized. If you want to issue more, you cannot issue. You need to go through to change the charter. It means you need to go through different terms of regulation. It's really hard to change that. So if you want to change that, if you want to incorporate, organize a corporation, you need to pay the fees, legal fees, lawyer fees, government fees, right? You need to sign the charter. You need to file different documents to the state, and you need to confirm the country's law plus company's law as well. So this is the hierarchy. So board of directors. So the shareholders are the owners. They elect board of directors, which elect the CEO, and CEO elect the COO, operating officers, and who ultimately elect the head of marketing, manufacturing, finance, human resource, and secretary, and all of those. You go down different paths. Okay, so hierarchy is that who are the owners, shareholders, who elect the board of directors. Every year they held a meeting.